Hello, Profit Hackers. I'm Jeremy Lott, the Chief Visionary for Foundation Accounting and Consulting. I owned a construction company for about 15 years before making a change to accounting because my accountants sucked. My goals are to simplify accounting for construction company owners, fuel your profits, level up your cash flow, and help you grow in a financially responsible way. So let's go. Hello, Profit Hackers, and welcome back to the Contractor Profit Hack Show. I'm Jeremy with Foundation Accounting and Consulting, and it is exciting to be able to move on from key performance indicators and from ratios and all of the math and start talking about some more concepts and mindsets, all right? Today, we're going to talk a little bit about scaling and how to scale your business, okay? And I want to share some specific stories from people I've worked with in the past. Now, a lot of these stories are not successes, they're failures, and they will help you understand what can happen if you don't follow the principles correctly, okay? So the first company that I want to talk about is a solar company that I worked with a while ago, right? And this solar company was founded by two salesmen. And boy, these guys could sell like crazy. They had a niche that they were going after, and they were dominating in that niche and just doing fantastically, right? Well, the way that most solar companies work, not all of them, there's some different ones out there, but most solar companies, the way they work is you're either a sales company or you're an install company. I think they call them PCIs. I don't know. I always get that acronym wrong, so I'm not even going to pretend. But you're either a sales company or you're an install company, right? Well, these two salesmen, their big idea was that, hey, we are leaving too much of the pie for everyone else. So what we need to do is we need to have our sales team continue on, but we need to be installing all our own jobs. EPC, that's what it's called. Anyway, we need to be installing all our own jobs. That's a great concept. And that's definitely a direction that is favorable to go, right? Well, here's what we ran into there. And again, this is why I now use that break even and why we can chart those different numbers and plug things in to see different scenarios and what break evens are, right? As they were going along, they were selling, they were making tons of money, right? And they were paying it mostly out to their employees. So the overall profit was decent. They were making good profit, especially for the two owners. But they weren't amassing a large amount of cash, right? And so when they decided to make this switch, they didn't get a line of credit. They didn't get any kind of loan. They didn't find another partner to come in or anything like that had money, right? What happened is they decided, okay, so if we're going to do electrical, one of the key requirements is an electrician. Neither of us is an electrician. So we have to now hire an electrician that's part of the company to be the qualifier for our solar company to be able to do installs, right? Makes sense. But how much does an electrician cost? How much does an electrician cost when you're paying him cash from your other business, right? Well, then other things had to be added. We had to have the right software for estimating. We had to have the right software for designing. We had to have the right software for this and for that. And their software costs built up and built up and built up. Also, you have to have people to be able to run the office for a solar company. And that usually requires some people that are pretty well trained in the industry, which can cost a lot of money, right? Do you see where I'm going with this? They hit a point here where their gross profit margin for their business was negative. They were spending more money than what they were bringing in from their clients. And as they continued to get more software and more office staff, they had to pay those people as they were going. But they were using all the profit from the company to do it, right? Well, that ran out pretty quickly. Then all of a sudden, that they had no cash, and the only income that they had was from these cells where they had promised to do the install, right? And so they started using that cash, the cash that was set aside for the equipment and for that install, to pay for all of their hill, the increase in their hill, and all the software and all the supporting stuff, right? And they got to a point where if you have a negative gross profit margin like they had, or if your cash flow is super poor like theirs was, you're going to use up all your cash. You're not going to have money to pay for all of your different expenses for each month, right? And you're going to be stuck. Now, I like to teach that if your gross profit margin is poor, fix that first, right? Focus on your bidding and estimating. Focus on your efficiencies, right? Focus on selling more, those kind of things. If that gross profit margin is low, those are the things that you need to be focusing on, right? When you have a good gross profit margin, and again, good is compared to the industry benchmarks, the industry standards, and we've talked about those before, right? The averages across the country. If you have that, then then you can dump more money into that company and grow it. You can buy new equipment. You can hire that electrician. You can hire the admin staff that you need. All those different things, right? But if you don't plan it and you just start saying, well, we've got to have these in order to fulfill over here, then you could also end up with a break even that's so high that you cannot ever get there. You'll never reach that goal and you'll never be profitable. Okay? And you want to know a secret? One of the biggest indicators, one of the clearest signs that somebody is in one of these situations is they start asking for investors. Anytime a contractor starts asking for investors, I've noticed that they have this problem. They've grown their hill too large. Their break even is too high. They cannot reach it. And they think that an investor can come in and pay those bills for them over and over again until they get large enough to cover that on their own. Well, I'm going to tell you right now Investors do not invest in concepts. They don't invest in ideas. They invest in individuals. And they want to put their money in people that are going to create a quick profit for them. That's what they're after, right? That doesn't happen with a concept. That doesn't happen with an industry, right? That happens with the right people. And so if you have gotten yourself into that situation where the break even is so high that you can never meet it without an investor, well, you're never going to find an investor that'll put money into that. It's just not going to happen. They're not interested. They don't want to talk to you. Stop harassing them. Fix the problem. Get rid of some of the software. Get rid of some of the staff. Get rid of your large office space. Whatever it is. Start eliminating some of that hill, the selling, general, and admin expenses. Start shrinking that hill. When you get to a point where you now have a break even that you can reach with your sales, your current sales rate, right? How many sales you have and what revenue you're targeted to make for the year. Then you can start looking at adding those things in one at a time. But before you do it, we want to throw it into that money machine calculation that we've put together, the spreadsheet. And you want to know how that's going to affect the break even, right? And so that, my friends, is how to grow a company. You don't want to start buying a bunch of equipment when you have a poor gross profit margin. You don't want to start spending all your cash on equipment or on people to grow the company. You don't want to do that right away. You got to protect that cash, right? Plan things out. Make decisions for 4 months from now rather than saying, oh, we've got to do this now, right? And then run it through all the spreadsheets and numbers and different processes that we've been talking about to help you know if you're in a position where you can safely take that on. Okay? I am Jeremy with Foundation Accounting and Consulting. I love helping companies grow without going broke. As I've said before, there are numerous studies out there about how many businesses fail, what percent of businesses fail in, 1 year, 3 years, 5 years, whatever the number is, right? And the secondary information that you get from that, from those studies, is that the number one reason businesses fail isn't because they can't sell. It isn't because they're not efficient, right? The number one reason those businesses fail is because they use up all their cash flow until the point where they have negative cash flow for too long, and then they have to declare bankruptcy to get out from under their debts. Okay? So make sure that doesn't happen to you. Please use these techniques. Get to know these different concepts. And I will talk to you guys in the next episode. Thanks for listening. If you found this episode helpful, please like and subscribe for weekly episodes to help you fuel your profit, level up your cash flow, and finance your growth. Until next time, go enjoy some green M&Ms and protect that cash.